Today, Wednesday, June 10th, the spot gold market displayed an extremely weak and collapsing trend, battered by a double whammy of a liquidity squeeze from a global market risk-off wave and mounting fears over Federal Reserve rate hikes. Gold prices showed no signs of stopping their descent during the Asian morning session. Following yesterday's crash, the price further surrendered the $4,300 psychological milestone, at one point plunging towards the $4,200 edge to refresh a near 3-month low. On the fundamental side, market sentiment suffered another massive U-turn. Although there were brief reports of a ceasefire in the US-Iran conflict in the Middle East, the fragile situation failed to trigger traditional safe haven buying for gold. Instead, it escalated into a market-wide, panic-driven sell-off where investors chose cash over assets, causing gold prices to rarely crash in tandem with U.S. equities, the S&P 500 and NASDAQ. Meanwhile, the macro interest rate news is tightening. The market is keeping its eyes glued to tonight's upcoming release of the U.S. May Consumer Price Index (CPI) inflation data, as well as tomorrow night's Producer Price Index (PPI) data, driven by the previous strong employment data and persistently high oil prices. The CME FedWatch tool shows that traders' bets on a December Fed rate hike have surged to around 70%. If inflation beats expectations again, expectations that high interest rates, or even further hikes, will be maintained throughout the rest of 2026 will be locked in, deal a heavy blow to non-yielding gold. From a technical perspective, gold has effectively broken below its 200-day moving average, approximately $4,430, completely opening up the downside channel. The MACD green bearish momentum bars continue to expand aggressively, indicating that bears are in absolute control of the market. For this trading session, the core overhead resistance has shifted significantly lower to the $4,366 level. If this cannot be reclaimed, any short-term rebound can only be viewed as a weak correction. On the downside, close attention must be paid to the defense of the $4,180, $4,150 zone. This content is for reference only and does not constitute investment advice. Trade at your own risk.